Hey, thanks for joining us today. I am thrilled to have Paul Healthwood in our office. Paul is a chartered financial analyst. He's with Robeco Boston Partners, and we're just thrilled to have him in here today for him to share his ideas and trends that he and his firm are looking at. We're very appreciative. This was arranged by Chris Mays at John Hancock, and we appreciate Chris making this possible today. Following this vlog, Paul is going to go into one of our meeting rooms here and speak to clients. The main thing I want to emphasize here is in no way is this product recommendation. What you're going to see here in the next few minutes is just how we interact and brainstorm with portfolio managers and other professionals in the industry on their ideas and their thoughts. Because the more groupthink we can have, the better off we can come to solutions for our clients. And on that note, Paul, welcome. It's good to have you here.
Thank you.
I'd like for you just to educate a little bit from the standpoint of certain trends that you and your firm are seeing in the industry right now, trends whether in the markets or in the economy, things that you think are just some hot spots or points that need to be made.
Sure. Thank you again for having me.
Sure.
And in terms of our view on the economy and the markets, we tend to focus on bottom-up security selection as the principal driver of things, but we do have a view on the markets, and we have been very constructive on the equity markets over the past 5 years. Obviously, we just hit our 5-year anniversary of the bottom of the market back in March of 09, and we have been very constructive on a valuation basis. Equities have been a very reasonable deal.
Sure.
And what you've seen over the last 4 years prior to 2013 is the equity markets have come all the way back. Company earnings have all come all the way back.
Right.
And so that makes us feel very confident that the levels of the equity markets are justified by the underlying fundamentals. What you saw last year is you continued to see earnings growth of about 9%. The market was up about 30%. So that differential between those two is a result of investors feeling an ability to take more risk and add equities to their portfolio. So if you look at the market today, the S&P 500 trades around 16 times earnings, which we would characterize as fairly valued, but that does not mean you can't make good money in equities. It simply means that investor expectations should probably be in the 7 to 9% range, which is what we expect earnings to do, as opposed to maybe 30%, which was certainly a great year last year. But a lot of that due to that improved investor sentiment and willingness to take a little bit more risk.
So the paranoia out there that we may see the great crash or that it's grossly overvalued, what you're really saying is your firm believes it's fairly valued and still has room to go up selectively.
Correct. We feel we're at a good spot on an absolute basis. On a relative basis in terms of investments, whether it be fixed income or other areas, we think equities are the best deal out there. And there are certainly some expensive parts of the market. I think we saw some of the social media names and getting a lot of headlines that are expensive and we think would be a bit dangerous. That said, we see very good opportunities in the marketplace, particularly amongst financials, banks in particular.
Still have a way to recover from the 08 downturn.
Yeah, it's interesting in that the banks have, they've really recovered quite nicely and that they've done a very good job of building their capital bases over the last several years. And the valuation of the banks is still attractive at or below book value. And just to give your investors some reference points, at the top of the market, banks traded about 2 times book value. So it's still very good valuation. And companies that we think can earn better levels of profitability than they're currently earning without Herculean assumptions of how their businesses will do. Meaning if you see some loan growth, some improvement in interest margins with interest rates rising, we think the banks are very well positioned, in addition to the fact that they'll be able to return some capital to shareholders through buybacks and dividends and things of that nature.
And talking about the whole banking industry, of course, a big topic is, this week Janet Yellen, spoke. What's your all's opinion in relation to her as Fed chairperson and from the standpoint of, just the what you feel like the Fed's dealing with this year.
Yeah, I think our view on the Fed is they've been pretty transparent about their intentions. They announced the taper in May. They delayed that decision a little bit, but have embarked on that towards the end of last year.
Yeah.
We think that's the smart thing to do, is begin to get the economy going on its own two legs, as opposed to with help from the Fed. There's been a lot of reaction, maybe overreaction, to Yellen's comments yesterday, that rates may go up 6 months after the taper ends. That's the trend. It's going to happen, whether the timing of it is anyone's guess. Our view is that you are going to see interest rates go up. We think that that's going to be fine. We don't think that's going to derail the economy. And part of it's going to be maybe because the Fed raises the short-term part of the yield curve, but the market is moving interest rates up on its own.
Yeah.
And we think that is going to benefit certain industries, the banks in particular, life insurance companies, other areas. And we also think it's going to negatively impact some of the areas that are more interest rate sensitive, such as REITs and utilities, names that have a pretty strong yield component that we have found to be expensive, so we've been underexposed there because of valuation concerns.
And in relation to the REITs and the housing market, that's going to continue to be a topic of conversation. You feel like the housing market's recovering, or?
Yeah, I think, and this is getting into a bit on the economy. I think we're constructive on the economy. You've seen the housing market bottom, auto sales are improving, other pro-cyclical type of indicators on the economy are getting better, and I think that's why one can feel confident about equities going forward, albeit we think will continue to be a slow growth type of economic expansion. Hopefully it can translate into improved jobs picture. So that's all happening, but just not as quickly as people want it to.
Well said. Well, now you understand why we enjoy brainstorming with people like Paul, why we have them into our office to share ideas, not only with us, but to relay those to our clients. Because the more we brainstorm, or as we like to say here at File Plan Partners, if we all walk in the room and agree, somebody's not thinking. So by having individuals like Paul and Chris Mays that we brainstorm with and others, we're able to just really have great dialogue and narrow down and look at where are the consistencies and trends that we might need to look closer to. So hopefully you've gotten some great information from this. I always enjoy the emails and phone calls and feedback that we get from these type of vlogs. And let's keep in touch. We'll definitely be following up with you and looking forward to your comments here today in our office. Thanks, Paul. Appreciate it.